timely, insightful, discussion and analysis of economic trends and markets. From Southern California to Sacramento, featuring business and political leaders, unique field reports. From Orange County and the campus of Chapman University, this is the Chapman Business Report.
And welcome back to the Chapman Business Report. It's our weekly look at business, financial markets, and a special focus on regional economic trends. I'm Pete Weitzner. I head up the broadcast journalism program. That's at Dodge College. It's a couple of blocks just to the south and to the west of us here on the campus of Chapman University. To my left, as always, my major domo, the boss, Dr. Esmael Adibi, the wondrous economist here at Chapman University. He plies his trade at Beckman Hall, a couple of blocks behind us, and at the Anderson Center for Economic Forecasting and Research. And in just a couple of days, as we record this at the end of June, he'll be putting out his 35th annual revision to his economic forecast. The 35th annual forecast taking place in Costa Mesa at the Segerstrom Arts Center back in December. So that gives you a chance to correct your mistakes, but also to allow for extraneous events, which we surely had last year. To name a couple, the Arab Spring, the tsunami and earthquake in Japan. Nothing, no natural disasters this time around. So I can assume, as we look at your forecast from December, you saw GDP at a little bit between 2.5%. You saw business investment improving, consumer improving, government static, exports lower. How'd you do 6 months later?
Everything is in place.
It is. Well, GDP came in the first quarter.
Weak.
But this is a GDP for the whole year.
Yeah, for the whole year, we were seeing about 2.3%. We still think GDP is going to grow by 2.3%.
So you think the last couple of quarters leading up to the election will be better?
I think it's going to be a little bit better, barring any unexpected event. But thankfully, as you mentioned, compared to last year that we had to do big revisions.
Sure.
There were so many unexpected events happen last year, such as earthquake and Libyan situation. This time around, we didn't have very many unexpected events, except we're still dealing with the,
so last
European
year the European
problem.
Crisis worsened, and this year it's the same.
It's the same.
And no one can believe they haven't.
Nothing else fundamentally changed. I mean, if you look at components of GDP, that's usually the way we come up with our forecast. There are four components. Consumption, the biggest one. Then is government. Then is investment. And then finally is export minus the import market.
What you said government static. Let me start with government. And really they haven't been. They've been less than static. They've been austere. They've been paring back, still letting folks go.
Yeah, there's no major change. When we say something is a static or a steady state, means there's no big swing one way or another. We expected them to be weak to go through this cutback, both on federal and state level, and that's what's happening. So no major change there. The changes that happen, which by the way offset each other, was consumers are doing a little bit better. So consumer spending, we think, is going to be better than what we said in December. But the export market is going to get a little bit worse, and that basically these two are going to be a wash, leading to about 2.3% GDP for 2012. But more importantly, Pete, we're extending it to 2013. You know, when we do our June update, we go to next year and we look at 2013. The good news is, again, barring any unexpected, we don't think this recovery is going to stall. We're going to continue to grow, albeit at very weak rate. And of course, we had to make a whole bunch of assumptions as we were making the forecast for 2013.
Such as, and as we record this, as a big Euro summit and a showdown between the French president and Angela Merkel of Germany. That they'll come up with something a little bit more concrete and far-reaching. In other words, not piecemeal, not Greece now and Spain.
That's what we're hoping. You know, that's what we said they have to do last year. We said that this year they have to do. The problem is, again, national identity, national interest still dominates the whole scene. Every country is there and for themselves. The good news is Greeks basically voted to stay in Europe. That was a very good news. Not because
and to accept the austerity versus
in a way though, you know, even market was prepared for them to vote no and leave. But the positive side of it was, if they would have left, the positive, or they would have indicated they're going to leave, there would be a big run on the bank already. There's a run on the bank in Spain. It would have been on Italy, because people who were sitting in Spain and in Italy on euro, they would say, gee, if we get out, what's going to be our next currency? We better take our money out and put it something else. Big drain on the banking system. So the fact that Greece decided to stay, that gave a little bit of a stability to the market. But the fundamental problem is the cost of borrowing still. Spain, Italy, they have huge debt. They have to borrow. And the cost of borrowing is hitting critical value of about 7% on a 10-year bond. And with that type of cost of borrowing, the pressure on the budget within these countries, together with the austerity program, is going to be so high that probably it's not going to be sustainable.
Thank God Spain looks like it's going to win Euro 2012.
That's the only positive, I guess, for them this year.
Yeah. But you mentioned, we're going to get a little bit more review your forecast from December, but you mentioned the consumer has been a stalwart. Yes. I wonder if the consumer is getting a little exhausted. We look at May retail sales, they were actually down, and as a broker friend of mine puts it, every day a retailer blows up. It's Bed Bath & Beyond one day, it's Best Buy, which I know has some extraneous situations Not extraneous, leadership situations. Don't you see that as well?
Oh, there is. See, last year was the best year for consumer spending. And the reason for it was obvious. It was pent-up demand.
Sure.
You know, that is auto, you have to just replace those cars.
Slowing down a little.
Even buying some flat TV, probably 2011 was the best time.
Slowing down a little domestically.
It's slowing down. And even buying gift, apparel, all that was the best last year. So the consumers are slowing down. I mean, we were talking about growth rate. The growth rate is going to slow down, but it still is going to be positive. Now, when you talk about retailers, a particular retailer versus another, it becomes really micro rather than macro. Total retail spending is still growing. Now, 1 month being down is not.
Actually, and that factored in gasoline. So the biggest reason is gas is up 50 cents in the last 3 months.
Because the way it's measured is in terms of dollar spending. If gas prices are lower, so the amount of spending on total gas consumption is going to go down, bring the total down. We believe consumers, they have enough juice with the job recovery, some job creation, lower unemployment rate. They're going to continue to spend. Nothing like they used to after deep recessions of 6-7% increase, but it's going to be just enough, about 2.9%, to give us a cushion here to offset the expected weakness from export. But again, whenever we talk about these things, we said barring any unexpected. For example, a positive development now is oil prices.
Absolutely.
Oil prices are going down.
Down $30 in a barrel in the last 3 months, and as I mentioned, on the retail level, about 50 cents in less than 3 months.
Yeah, it should have, even for California, gas prices should have gone even lower.
But we have added costs.
We have added costs. One of it is excessive cost on refinery, limited refinery capacity.
A number of them were shut down.
Yeah, and it's a little bit of a typical, you know, during the season. They go out through
There's talk of $3 gas, though, once we get through the summer.
I doubt it. I doubt it. And actually, in a way, that's not going to be good. I hate to say it. It's a double whammy here. If oil prices go too low, let's say it goes, right now it's about 80, let's go to, I don't know, 60. Why? It means growth, worldwide growth is slowing down, which is bad news for the entire economy.
Doesn't it also mean, as I understand, the U.S. is at an all-time high?
Yeah.
In our own, I know we still import more than 50%, but in our own, we're up 700,000 barrels a day. Is that correct?
Yes.
That's a good thing.
That's a good thing.
That's jobs.
That's job. But again, why oil? See, oil prices swing, but oil has to go based on supply and demand. If it goes excessively over, I don't know, 100, 110, 120, 130, it's due to some geopolitical or external factor, which is a bad news because cost of gasoline goes up, cost of energy, cost of airfare goes up, which is not good for the economy. On the other hand, if oil prices is heading 60, 70, then it means the economy is slowing down, which is a bad news again.
Down to 8%, India's down to 5%.
All of that are surprising.
And Europe is negative.
Europe overall is negative. It's still, you know, a few of them are doing well. So overall, again, let's paint the big picture for the U.S. economy.
We got to get to jobs.
Yeah, barring any unexpected event, we think GDP, which is total spending, all components, is going to grow 2.3, going up 2.6%. But may I talk about big assumptions here? We never got there. The big assumptions is next year taxes. So
no, but you had that. I'll give you credit. You had that in your forecast. You said these were your concerns: the European crisis, and well-founded. China's willingness to buy U.S. debt.
They're still doing that.
The tax option.
Tax option. See, when we were generating forecasts for 2013, we said, gee.
And California's ground zero for that.
California has its own issue. But federally, we said, okay, what's going to happen to Bush tax cut? Because that's supposed to expire by 2012. We made the assumption that it's going to be extended. Most of it is going to be extended. We believe whoever is going to be the president, whether it's Obama or Romney, they're going to realize the reality that the economy is too weak. And they cannot increase taxes when the economy is so weak. It's to their interest and the interest of the nation to extend most of it, if not all, through the next year. So that was our biggest assumption. If that doesn't happen, then that's going to be a big hiccup.
How about the other side of what's called the fiscal cliff? If those automatic spending,
I think they're going to relax that one too, because that's our assumption again.
Right.
Because if that kicks in again, it's the situation in Europe that you want to promote austerity, but the austerity program during weak economic conditions
jump up the jobless
is going to cause problem. And finally, it was a payroll tax, which is going to get, again, go back to
2%.
2%.
We are now 3%. Did they add an additional 1%?
We are, I think it's still 2. I think it's 2.
There was talk of another 1%.
Yeah, 6.2 to 4.2.
Right.
And there we are assuming it's going to go back to 6.2. Obviously, if they extend that one, it would be added, positive news for our economy. So I needed to clarify that before we go to the job numbers.
Okay, so let's look at the jobs numbers, and I have to say you kind of hit that one 6 months in, kind of on the head.
Yeah.
We had a couple of 200,000 months, but now we're below 100,000. Your average was 144,000. You say we need that much just to stay steady, and that's what we're doing. We're at 8.2 now, I think, nationally.
Yes.
And you predicted by December we'd be at 8%. So you nailed it, but nobody's holding a party for 8% unemployment.
No, you can't be happy with 8% unemployment rate for a number of reasons. First of all, these are official rates. That means they're calling people, and lots of people think, by the way, let's clarify this too, they think if you're drawing unemployment insurance, you count. If you don't drawing unemployment insurance, you don't count as unemployed.
Some have exhausted the 99 weeks.
None of these are, I hate to say it, relevant when they compute unemployment rate. The way they do unemployment rate, they call people, sample, 60,000 people. They call you and say, are you working for 1 hour a week for pay? If you say, yes, I'm working 1 hour a week for pay, they count you unemployed. So even when you look at the unemployment rate of 8%, and you would say, gee, 92% are working, there's lots of underemployment going on.
Forget the term of art, but that figure that accounts for those who have given up the search, who are underemployed and not working.
When you add all that,
16%.
16%, yeah.
On this day, Wall Street Journal, front page story, fully half of lawyers, graduating lawyers, cannot find work in their chosen field.
I know some people say
that's a small handkerchief.
Some people say, but again, it's a sign of time. Look at what legal profession does. Is mostly business dealing.
Sure.
It's merger acquisition, buying companies together and making deals, and if economic activity is weak, do you need that many lawyers?
But likewise, big story a few months ago that regular college graduates, half are either unemployed, underemployed,
or are in different professions than they want to be. Yes, yeah, but
older people for the highest unemployment that they've seen in a recovery.
Having said
45 to 64.
Having said this, situation is a little bit better than what it was last year this time for college graduates. Things have a little bit improved.
No doubt.
And then depending on the profession, what profession they're looking for. For example, we are seeing a huge growth in professional business services.
Here in Orange County, about 13,000 jobs last year. That's engineers, that's architects, it's computer design people, it's lawyers actually.
Accountant.
And a lot of finance people.
And accounting. So
Orange County kind of bucking the trend, by the way.
Yes, when you look at professional business services again, we are doing really outperforming everybody else. But that sector, even at the national level, is doing extremely well. But when you look at other areas that are lacking this type of jobs, when we talk about Southern California later on, when you look at the Inland Empire, for example, Fresno, Modesto, that it doesn't have as many computer programmers, legals, and accounting and finance jobs, they're lagging. They're not growing as fast.
And I believe as we record this, you mentioned Northern California. Is it the city of Stockton that's weighing?
Yeah, financially, there are lots of cities.
Bankruptcy would be one of the largest. We know about this here in Orange County. Would be one of the largest Chapter 9 filings in municipal history. Take a quick break. We'll look at some corporate and local company. Quicksilver. You mentioned retail, and here's a company that is doing better, but struggling to grow the top line. Look at their earnings. Back with more with the boss. Look at some more current conditions and the revision for the forecast on the Chapman Business Report. Welcome back to the Chapman Business Report. Pete Weitzner joined by the boss, Dr. Esmael Adibi, and a trooper, by the way. The man has been felled by bronchitis since Hector was a pup, and he's back with us. And you got to do a command performance later in the week.
And I hope you can tolerate me.
So I'll let you know in a few days when we have someone else probably in this chair for the next one. But it is all about jobs. Of course, it's an election year, but it's all about jobs for, obviously. We're at 8%. What would it take? We need 250. Last couple of reports have been miserable. 60,000 jobs net in the month of May. What would it take to get that figure back to 250,000? It's probably not going to happen this year.
Give certainty to employers. That's part of the problem. First, when we started the year, we were talking about nation. January and February, we were over 250,000. Part of it was seasonality. The reason was the weather was extremely warm.
Forgive me, they won't get certainty before the first Tuesday in November, right? I mean,
in a way. I mean, you could look at it that way. But there are other signals that comes out that it's not just presidential election. Let's go back again. January, February, over 250. Part of it was seasonality. Weather was nice, so typical layoff didn't take place and got moved down to maybe March and April. But then the new numbers of 60,000 is extremely low. That you cannot justify it just because of seasonality. Clearly, employers are again pushing the brake and they're pausing. And the reason being, I mean, if you watch, maybe average person doesn't watch CNBC or Fox News or reads Wall Street Journal. From every corner, uncertainties are coming in.
Sure.
What's going to happen to our taxes? What's going to happen to healthcare? What's going to happen to Europe? Is there going to be a huge recession in Europe? Is there going to be recession?
Volatility in the financial markets.
Yeah, and all of that. When employers look at this and they say, "Am I going to commit and hire 100, 200, or 50 more workers?" And they say, "No, we better wait." So that's part of the problem. So the more clarity kicks into the financial market and economic statistics, then you would see those jobs come in.
This was such a steep recession, the Great Recession, steepest since the Great Depression. And usually after a steep recession, you have a big spike up, and we haven't. GDP since the end of World War II has averaged 3%.
Yes.
Glory days in the 80s, 4.3%. This current recovery, only 2.4%.
Yes.
Can we lay it all up? I know we've had Europe lately, but that housing has not been a component. Is that the biggest
just
thing?
Blame it on housing.
That's 1% of growth.
It doesn't matter. 1%, you think of multiplier effect.
Sure.
If you think of what industry has the highest multiplier effect, which by multiplier we mean when you spend $1, how much you get extra out of that $1 is spending, is construction. Whether it is actually residential has the highest multiplier, more than commercial or heavy construction.
More than
roads.
Government jobs, huh?
Oh, definitely more than government jobs. So you can imagine when you want to build a home, what's going to happen? First, obviously, you have to put everything together, drywallers and carpenters, and then appliances kick in, and then landscaping kick in. So a whole bunch of different sectors are going to benefit from residential housing.
Building inspectors get hired.
Yeah, but compared to, let's say, heavy construction, building a road, it's not that labor intensive. It doesn't have as much.
We didn't do
multiplier.
enough of with the
we should have done it with the stimulus.
All agree.
Yes.
The postulate that we mentioned some people have exhausted their unemployment as high as 99 weeks, a record. Some have put forth that has diluted the incentive to work. Another reason that figure is in the low 8s nationally. Higher here in California, almost 11%. You agree?
I agree. Not necessarily. See, we have to be very careful. We have to break it down, the benefit that we were giving to the people. If somebody was making $150,000 annual income, and now is getting unemployment insurance, which is going to be a very small fraction of what he was making, for him, that amount of little money he's going to get is not going to be enough to not to look for a job because he was earning under 50,000. But let's say somebody was making 25, 30, 35,000. In that kind of an income bracket, what they get from unemployment insurance, in a way, is a higher fraction of their income, and in a way, it gives them a kind of if it's a second income earner, it's a good time to pause and sit home and take care of the kids and maybe relax a little bit. I'm not talking about everybody, but so the income bracket is very important. So at certain income bracket, I have no doubt that extending unemployment insurance discourage people to go out and look for undesirable jobs. See, the problem is everybody maybe is looking, but they want their perfect ideal job. And if they're getting that unemployment insurance, they would say, oh, if it's not coming, you know, I'm not going to take this one. Take this one. But if that money is not there, they're going to take it, whatever is available, and that by itself is going to be a stimulus and it's going to help the economy. Why are you smiling?
Well, no, because we're getting to your favorite part. We're not a political show, but you do use your model every 4 years, you and Jim Doty, to predict which party will win the presidential election. And in fact, it's been right 16 of 17 times.
Yeah, exactly.
I forget the one. Was it 92 that you missed? I think. Yes.
I think it was
92.
Yes.
Bush 41 did not win re-election. Well, using real GDP growth, which is a little more than 2, job growth, which has slowed, and November 2011 approval rating, you forecast back in December that the GOP would win by 8%. I guess
popular vote.
Popular vote.
Popular vote, 8.1%.
Doesn't necessarily mean they'll win because it's such a scientific electoral college election.
Exactly. The funny part was when we ran the model and tested it, as you said, 17-time period, 16-time works, the November reading popularity of a incumbent became very important, and we were very puzzled. We said, why November? Because the election is going to be a year after. But still, the model was showing that's very significant. Now what we did, we said, okay, let's put the new number, the popularity number, put the new GDP job numbers and see what happens. Still, the model is showing that there would be Romney victory now that we know who's the candidate, but the margin shrunk to about 3.1% popular vote.
You're right in line with what everybody said.
Yeah, 3.1% popular vote. And now the question is, of course, how it's distributed among the states and electoral vote, and how tricky that becomes.
We're going to be up all night waiting on Florida and Ohio.
I think it would be a close call. Yeah, I think it's going to be, barring any
different news ratings.
Yeah.
A couple of last things just to see how we're doing right now. Mostly mixed signs. Fed in some parts sees manufacturing slowing, but leading economic indicators are up. And I guess again, owing to gas prices, we're seeing inflation actually fall. The CPI was down 0.3%, and that's good news.
Yeah, let's address each one of them very quickly. Manufacturing is dropping. ISM, which is measuring manufacturing activity for good reason. Recession in Europe, more or less. Our export is depressed to Europe. And China is slowing down. That again impacts our manufacturing. And the fact that business investment is not as strong as it used to be. Business investment is in hardware, software, and that's not there. So that's not surprising. But having said this, still manufacturing number is over 50. ISM number is about 53.5, which means growth in manufacturing. Going to the gas prices and inflation, that's a good news for consumers. I mean, we love to see lower gas prices. We love to see lower cost of energy as component of consumer price index, which basically means more disposable income for other things. But as we said it in the first segment of the show, if oil prices are going down because the economy is going into a recession, then that by itself is not a good news. But we take it. Lower gas prices, we take it. Lower consumer inflation, we'll take it. It's a good news. More money to the consumers.
We talked about Orange County doing well, professional and business services jobs. We had about 2% job growth.
And leisure
and hospitality.
Yeah.
We're at about the lowest unemployment rate of the 57, 58 counties in California. Why so much better? Or is it not just Orange County? It's kind of a coastal phenomenon.
Yeah, we kind of alluded to that. Diversified economies are doing better. Anytime you come out of the recession, those economies that can benefit from multiple engine of growth rather than single engine, they're going to do better. So if you go up and look at, like San Francisco area, they're getting tourism, professional business services, financial sector is doing good. Now, Silicon Valley, you would say like a single engine economy, but that single engine is a huge engine, so it's helping them. And when you come down again, come to Orange County and San Diego, and even western side of Los Angeles, we're doing better, mainly, again, leisure, hospitality, professional business services, healthcare, and private education.
Just wrap it up, quick comment. It's now been about 5-6 weeks. The whole Facebook IPO, black eye, it's gone. I noticed there's 4 IPOs. First IPOs since Facebook. It's gone. Obviously, NASDAQ will do better. and maybe the investment bankers and Facebook won't be so greedy and price lower next time?
I believe so. I mean, this was a good lesson to everybody. You know, they got into the habit of jumping
out of the balloon, right?
Exactly.
California was counting on $2 billion in tax revenue.
More, actually. I read some more numbers on that. But they're still going to get it over time. You know, these people are eventually, this is the stock.
The shares keep going down.
Over time. It's not going that far down now. What is it, about 28 or so?
Okay.
That's not bad. And some people were saying you should go down to 15.
They expected it to pop to 50.
But the mistake was, obviously, they priced it wrong, and that's the biggest mistake. When in the IPO industry, you want to price it in such a way that when you bring it to the marketplace, it jumps by 10, 20%, and that by itself gives incentive. Next time you're bringing something else, people line up to buy. But this time, really, Morgan Stanley, I guess that was the lead
underwriter.
It's a really lack of confidence in their ability to price the security correctly.
Lots to take up on our next chat with the boss. Good luck on your 35th revision. Good luck getting healthy. That'll get you healthy. I know you love to talk before a big audience.
Yeah, I'm getting excited.
A resurgent Orange County real estate market. We'll talk about that. What if, when the healthcare ruling comes down, why Europe can't get a comprehensive plan? Lots to talk about on our next Chapman Business Report. We thank you for watching. To Jeff Cole Productions, Chapman University, class of 2001, his crew, they put on the Chapman Report. Thank them very much. Thank you for watching. We'll see you again next week.
Funding for this program was provided by Chapman University.